Right, sorry, good evening again, everybody. Sorry about that. We obviously experienced a little bit of technical difficulties at our end. So without further ado, let me introduce you to Richard Baldwin, who will take you through the topic this evening.
Okay, unfortunately, I still can't see the slides.
Richard, have you pressed join?
Beg your pardon. Let me do that. Excellent. Yep, that's great. Hopefully you can see me now. Well, thanks very much, Dave. Welcome, everybody. Tonight's topic may not be terribly familiar to all of you, but hopefully at the end of it, it will be more familiar. My format this evening is to cover corporation tax in quite a high level in four main areas, which you can see there on the screen. The clubs it applies to, what are taxable profits, how many deductions and exemptions can you get? That's always very interesting. And finally, what you need to do to comply with HMRC's requirements. So, as I said, the objective is really not to give you lots and lots of detailed technical stuff, totally inappropriate for 7:15 in the evening, but to raise awareness of corporation tax and perhaps prompt you to a review. So it will be at a reasonably high level. In practice, you need to get your hands dirty, I'm afraid, by looking at those annual accounts and deciding whether you've got any corporation taxable income. This tax, corporation tax, is a tax on companies, and sports clubs are companies for this purpose, and it's quite different to VAT, which I know you had an excellent VAT webinar on. So let's just move on and take a quick poll.
Thanks, Richard. So I'm just launching this poll, and we're going to do quite a few polls this evening. And the question we've got to sort of start with is can unincorporated member community rugby clubs ignore corporation tax? Yes, no, or don't know. As I say, if you have gone into full screen, you will need to come out of that to see the poll. But if you could complete that for me just now, that'd be great. We'll be doing quite a few of these this evening, sort of see what the knowledge is out there, and then for Richard to give the answers. I'm going to gather them poll results now. So, interestingly, no, 60%, and don't know, 40%. Okay, I'm going to publish those results to you. Back over to you, Richard.
Oh, that's excellent. Well, that's good that we've got 60% no's. 40% don't knows. Well, we'll concentrate on the don't knows, but I'm sure the no's can learn something. Sounds like a vote in Parliament, doesn't it? So those that said no, they cannot ignore corporation tax, absolutely right. Whether you're unincorporated, i.e. just a straightforward constitution, incorporated, as quite a substantial number of rugby clubs are, either as companies limited by guarantee, registered societies, the old IPS, or a community interest company, you will need to consider corporation tax. And this is even the case if you're registered as a CASC or a charity. And it's fair to say that legal liability status does not confer of itself any special tax status. So what you have to work out is, have you got any taxable profits? Because if you are, you will be liable to pay corporation tax on them. And that's really what the remainder of the presentation is going to be dealing with. And I'm bound to say that in your resources, there are two sort of fairly high level guidance notes from HMRC, but in practice, the working out this situation for corporation tax is not straightforward. But hopefully after this session, it will be more straightforward. So what are taxable profits? How do you arrive at them? And at the end of the day, it's a 19% charge, so it's worth avoiding if you can. And the general outline, what you have to do is to look at whether you've got profits from taxable sources, because the tax legislation identifies tax charges where you have a taxable source. And it doesn't mean that everything that you earn is a taxable source. So you look through each source, find out whether it's a taxable source. You're then allowed to deduct expenditure, costs of earning that income. You add up the taxable profits from each source to get total profits, and then you're allowed to make certain general deductions to reduce those taxable profits. And if after those general deductions a taxable profit remains, then the corporation tax rate swings in at 19%. They were going to reduce it to 17%, but with the pandemic and the lack of government funding, they've decided not to do that. So it's 19%. So let's just move on to the next poll, and over to you, Alex.
So is your club filing corporation tax returns? Yes, no, or don't know. That's with you now. As I say, you do need to come out of full screen if you've gone into that to see the poll. But just quick one, we won't give it too much time, but please let us know your answers. I'm going to gather those poll results now. So we've got yes, 50%, no, 21%, and 29% don't know. I'm publishing those results to you now.
Thanks very much, Alex. I wouldn't criticise the don't knows too much because if you're not in a treasurer's role, maybe you won't know. But hopefully this will enable you to find out, and if you don't know, to determine whether you should be. And for the ones that are not filing, maybe they should be filing. I thought what I would do would start off with a very, very simplified set of accounts for a rugby club. Now, you may say, well, this doesn't reflect us, and it probably doesn't. But it's up there really to make a point so that I can use it to pick out some of the captions and explain how they may be treated for tax purposes. This is not a COVID accounting period, not a pandemic accounting period. The results might look completely different, and it's not a registered club. But subject to that, as you can see, it's a relatively small club. It's got a bar, it's got its own premises, and it's in the fortunate position that it's broken even. So, having set the scene with that, the next question is, over to you, Alex.
So again, that poll should be with you now. So since there is no surplus, will there be any taxable profit? Yes, no, or don't know. And I've just seen one in the chat sort of saying, does anyone actually make a profit? An interesting question in itself. But yeah, since there is no surplus, will there be any taxable profit? I'm just going to gather those poll results in now. So yes, 20%, no, 20%, and don't know, 60%. I'm publishing those results now.
Oh, that's brilliant, because I got 60% of the audience at least to work on. The answer is that there is very likely to be some taxable profits there because of the analysis of the sources of income to see which of those are taxable. We won't know that until we get to the end at the end of the road. But the fact that the accounts show a break-even situation is not the determining factor. The accounts are very, very important as a starting place. They should be proper, accurate accounts, completed in accordance with generally accepted accounting principles. That's a bit of jargon, but yeah, they should be proper accounts so that the revenue and yourselves can rely on them when looking at your tax liability. There are three potential taxable income sources that those simple accounts demonstrate. And one is there any trading income? Secondly, is there any property income? And if you looked at the third line down, sorry, I'm not taking you back to it, but the third line down in the income category, there was another category which includes some rent. So that was property income. So we've got to look at that closely. Didn't show any interest income. Maybe many clubs don't have any bank interest these days. I know the banks are very sparing when they come to paying you interest, but bank interest income will be a taxable source. So should we have a look at those, perhaps the first two, which are the ones that are of more concern to most clubs, a little bit more, in a little bit more detail. So is the club trading? Now, having answered that question, I have to say to you, the answer is not easy. There is no legal definition of trading in the tax law, and it's developed, as you might imagine, in terms of case law over many, many years, and it does depend on the facts. For those that are interested in, or those that are insomniacs, there's extensive guidance on clubs on the Inland Revenue website, which will surely put you to sleep. But there are pages and pages of it. What is trading? And there's a particular section on members' clubs. But the good news is that since the Revenue consider that most member sports clubs are there for social and recreational purposes, their objects are not to make maximum profits for some proprietor. They're really to provide funds to invest in the business and to keep the sport running at a reasonable cost. The Revenue accept that membership fees and generally income derived from members do not constitute a trading activity, which is excellent news. Now, some of you may be saying, well, surely we're mutual traders and therefore that takes us out of any tax charge. A phrase that is much bandied around by sports clubs, but that you don't need to get to mutual trading. You only have to get to mutual trading if you're trading in the first place. And if you're only transacting membership transactions, fees and subscriptions, and a bar that's a members only bar, then you're not going to be carrying on a trading activity. It's only where you are carrying on a trading activity and that trade realizes profits from your membership that you are exempt from those profits under the mutual trading principle. But in order to do that, and I know this creates quite a bit of problems with sports clubs, you have to be able to demonstrate that if you wound up the club, the profits, the surpluses would go to the members. And that is not always the case. But you don't need to worry about it at all, in my view, because we never get to mutual trading because we're not trading in the first place. So what element of your activities might be trading? And here I point to the bar. As you can see, there was 55,000 of income from the bar, and the rules are, the guidance is, and it is guidance, but I would imagine that you would have to show really good cause if you didn't follow it from the Revenue. Yes, there is some trading there to the extent that you're providing food and drink or services to non-members. So I know it's not rugby, but in golf, there's some classic guidance on green fees, where green fees are taxable to golf clubs, and there's a huge amount of guidance on how a golf club would approach that. But for rugby clubs, the principle is, yes, if you've got non-member income from the bar, then that is trading income. So let's just have a look at non-member income. I've said that rather blithely, yeah. I've confirmed that HMRC regard that as a taxable trade. And so you might say, well, okay, what is membership income? Well, if we're looking at that bar, who is a member for this purpose, and we can ignore their purchases. Well, unfortunately, the Revenue are fairly strict on who they regard as a member. Basically, they look at voting members, and they would include juniors who wouldn't necessarily have a vote. And they say, well, basically, it's those sorts of members that we can ignore. So, for example, visiting teams buying food and drink at the bar are not members. They go into the non-member category. Visitors, similarly, and guests, they also fall into the non-member category. However, a big plus, if you're generous enough as a member to pay for all of your guests or your visitors, you can ignore that income. Fairly detailed stuff. I'm sure you will appreciate that this is not necessarily easy information to get hold of, but the Revenue say, well, the club needs to keep records. We are a nation of record keepers, so why not keep records on this? This is what the law says. Anyway, we'll leave the income side for a moment and say, well, okay, so your non-membership income from the bar is £10,000, say, in that particular year, they were the purchases. You don't pay tax on that. You are allowed to deduct, obviously, the direct costs, the cost of the food and drink for supplying those sales of 10,000, and you're also allowed to allocate general costs of running the bar and overheads of the clubhouse. So, next poll. Interesting question.
So yeah, I think Richard said it right. A very interesting question. So looking at the bar sales, are you recording non-member bar sales? And if you are, how are you doing it? Is it through an EPOS, membership card system, sampling, or other? But if you're not at all, let us know. Have a think about that for just a moment. I'm going to give you a bit more time on this one. A very interesting question, as Richard says. So I'm going to gather those poll results in now. So thanks very much for doing that. And I will just give a bit of a summary. So we've got some EPOSs in play with 17% with that. We've got membership cards in play, so 33%. Not at all, 33%. And don't know, 17%. I'm going to publish those results. Back over to you, Richard.
Well, that is really good news to know that half of you have got a method of measuring those non-member sales. So take a bow. For the others, just to confirm that those methods that were listed are potential methods of validly identifying the non-member income. And the guidance specifically states that it's not necessarily reasonable to expect detailed records in all situations, and there you can accept a sample for some representative periods. So that's why the sampling was up there. I don't think anyone was using sampling, but that is permissible. And I guess if you've done it once and that is typical and that doesn't change, the balance between membership and non-membership purchases doesn't change, then you could use that in the future. Technically, you should do it every year, but I'm sure the revenue would accept a basic percentage calculation and apply that consistently unless anything changed. So having dealt with that potentially difficult bar, the trading category, let's move on to property income. So this is slightly different to trading income because it's taxable even if it's from a non-member, even if it's from a member. So whether it's from a non-member or a member, property income is taxable. So a car park or a clubhouse hire with no facilities, no support, no staff, nothing else provided to a third party or to a member constitutes taxable property income. However, if you are providing staff or other services in connection with the hire, then it becomes trading income. So there's quite an interesting distinction, which is quite an important distinction. So that would be the case if the bar and food service was provided to someone who had a wedding anniversary or a conference or whatever there. And the real important point here is that if that is a member that's doing that hiring, that full service bar for a wedding, then it becomes non-taxable. It's non-taxable trading income. If it's a non-member, it's trading income. So just please bear that in mind. I think obviously what it does involve is you looking at all those occasions where you're hiring your facilities out to anybody really, and in the first place determining whether it's a pure hire, and then if it's more than that, if it's to a member or non-member. So that's on the slide, so remember it, refer to it, and again, whether it's property income or trading income, costs can be deducted from it, so the costs of the earning the income can come off that. So just moving on to other potential sources, and I sort of make no apology on this next slide for just repeating what's in HMRC's extensive guidance on clubs. not particularly sports clubs, but clubs in general. And I'm not going to go into any of these in detail, but the guidance is quite firm in stating that sponsorship and advertising income is taxable. The only instance where a sponsorship is not taxable is where it's done in a personal capacity with no private benefits, nothing to do with the business. So I, as an individual, might sponsor the shirt of a player. I don't get any benefit from it, and it's purely done in a personal capacity. That would not fall into the sponsorship category. But I guess most of your sponsorship will be not in that category, commercial sponsorship, and will be taxable. Take-ins from functions. Again, I've talked a little bit about hire of facilities in the property income slide, but the guidance says, yes, weddings and conferences, takings are to be taxable. I think probably the revenue had more in mind perhaps bar takings, food takings, etc. But you need to look at that one. Regular fundraising events is probably a very difficult one. There's a very old case going back 50 years, over 50 years now, actually, it's 60 years, whereby a series of weekly fundraising events was held to be a taxable trade. And so you need to look at the regularity of your fundraising events, who attends it, whether it's really a commercial event or whether it's very much internal to the club. And if it's the latter, then you can probably not treat it as taxable. But you need to really look at those fundraising events. Finally, I put grants up there. I'm not going to worry you. I think most grants that you get will be capital grants, so are not going to fall into the taxable net. They're going to be referenced to the capital spend that you incur. But if you are providing any services or facilities under a contract, a grant agreement with the grant giver, then that may bring you into the taxable net. But generally, I think grants won't be taxable. But I make one very, very important exception to that, which we're going to come on to later, and that is the coronavirus business support grants that I'm sure a lot of you have got. So let's just move on to the next subject. We've dealt with trading income, property income, other potential taxable sources. We're now going to move on to a poll.
Yes, so we've got another poll with you, and it's with you now. Do clubs pay corporation tax if they sell their land at a profit? Yes, no, don't know, or it depends. So we're hopefully getting a bit quicker on these ones now. So I won't give it too much time as we get through the webinar this evening. So I'm going to gather those poll results now. And we're in. So yes, 44%, and don't know, 56%.
Okay, excellent. Well, the answer is a sort of a potential yes. So for the 44% that said yes, well, yeah, potentially, absolutely right. Usually, very often, a capital project is funded, at least in part, by a land sale. And sometimes clubs will move facilities. They'll sell their existing site off to a developer and then reinvest the proceeds in a new site, a new club has better facilities. Well, potential CT liabilities arise in two areas. I'm going to concentrate on one in a minute, but the first is just that by building those new facilities, extending your facilities, you may develop more commercial income. So when you're planning your funding of all of this, and perhaps you've got a loan as well, you need to take into account there may be some CT payable before you've got some money to repay the loan. But by far the biggest issue, which I've come across quite a lot in the last 2 or 3 years advising clubs, is that there's likely to be a capital gain when you sell some of the land. And the capital gain would ordinarily be subject to corporation tax at 19%. However, if the proceeds are reinvested, the capital gain can be deferred, probably in effect indefinitely, because it will only crystallize when you sell the asset that you've reinvested the proceeds in. So you can reinvest your process in more land, or improving your buildings, or improving your capital improvements to your facilities, to your pitches, etc. But you need to take great care. First off, you must reinvest all of the proceeds to get full deferral of the gain. And secondly, there's a time limit of 3 years for you to do that. And thirdly, it's got to be a qualifying reinvestment. So that is basically fixed buildings and land that you've got to do it. And this is the plug, the marketing plug for the last category of registered clubs, because casks and charities don't pay any tax on their capital gains, provided certain conditions are met. So we will deal with that briefly a little later. So we've identified at least three potential sources of taxable income and profits. Well, what about perhaps the slightly better news? What deductions can you take before you actually arrive at the taxable profits themselves? Well, I think I'm sort of covering a little bit of what I've already discussed. The direct costs of earning the income are allowable. You are allowed also to allocate overhead costs, which is likely to be the case with the bar. And particularly with the bar, when you've got the bar costs that are allocated to it, you have to apportion it between taxable and non-taxable. Very logical, but unfortunately that is the case. Finally, in the bottom right-hand square there of the square, capital allowances would be a webinar in itself, but you are able to claim capital allowances on plant and machinery, and also for the last 2 years, the government have very kindly introduced the structures and buildings allowance, whereby if you make improvements to your buildings, your clubhouse, then you are allowed to take tax relief. Not a very generous rate, 3% straight line over a period of 33 1/3 years, I'm afraid. But nevertheless, it's there, and we're all about eking away and reducing those taxable profits. And if that helps, very good. Let's hope it does. So, though the deductions against sources of income, having got to that level where we've identified all our taxable sources, we've added them all up, we've come to taxable profits. We're then allowed to take some general deductions, which these are not apportioned or reduced in any way to reflect the portion of the activities that are taxable and not taxable. So this is good news. There are two of them. I was talking to a club the other day that actually, out of their own resources, made a donations to local charities. Well, that is deductible in full. So if in the year you give a local hospice £500, that comes directly off your total profits before you arrive at your taxable profits. Another relief, which I suspect has been much overlooked, is the new relief that Rugby and the Sport and Recreation Alliance, which I assist, worked on with the government for quite a long time, is you get tax relief for any grassroots expenditure up to £2,500 a year. I'm not going to go into the detail, but for example, this would cover a junior coaching course run throughout the season for all the juniors in the club. The cost of that might be coaches and refreshments, etc. That sort of thing, where you are promoting amateur sport for the community, then the expenditure you incur, provided it's not met by a sports council or another grant, you can claim this relief up to £2,500. So very worthwhile looking at that, particularly if you're going back now and seeing, well, we may have had to have filed tax returns. How can we get the liabilities down? Well, that's been there since April 2017, so we've had 3.5 years of it. So I hope it would be valuable to you. I'm not going to deal with this on this slide, but registration as a cask or charity is, we will go into that and what Ct exemptions that delivers. But before we do that, I'm going to go on to my favourite subject, which is coronavirus local authority grants. So over to you, Alex.
That poll is with you now. So, hot topic. Obviously, a lot of clubs got a coronavirus local authority grant, and but are the coronavirus local authority grants taxable? Yes, no, or don't know. let us know your thoughts. We won't give it too long. Hopefully you're sort of getting into this, our sort of quiz approach tonight to this this webinar. So I'm just going to gather those results now. So interesting. 39% said yes, 44% said no, and 17% said I don't know. I'm going to publish those results now.
Well, it was a bit of a trick question because it does depend. And I think when I've been through this slide, you'll see how important it is to have addressed all the other issues that we've just been through. Because yes, they are potentially taxable. And Finance Act 2020, which passed earlier on this year, actually prescribed the legislation for making them taxable. And this slide is based on that law, which at best is unclear, and conversations I've had with HMRC. We have no guidance on this at all so far. So why do I say they're potentially taxable? Well, they're taxable if you have trading or property income. And we've been through all of that. If you have no trading or property income, the third bullet down on that slide, you only have non-trading member activities, they're not taxable. And if that's all you've got, don't worry about coronavirus business support grants. But the chances are that most of you will have bars, or you will do some hiring or some rental, have some rental income. And in that event, you'll have both taxable and non-taxable income. And what you have to do, the legislation says, you have to apportion that £10,000 or £25,000 grant, I think it's 25, between the two categories. Doesn't tell you how you do it. I've suggested that you might do it based on gross income or turnover. You might do it based on the expenditure on the taxable sources or the non-taxable sources, respectively. But you have to address it. The grants themselves, I think, gave you no clue as to how they were to be allocated. The tax legislation doesn't give you any further clue, but hopefully when we see this guidance, it might give you some indication of how to do it. I mean, I might say that these support grants, I mean, they're not just aimed at sports clubs. You know, your local retail shop, corner shop, it's going to be fully taxable because their activities are going to be fully taxable. So this has created a bit of a headache, I think, for the revenue and treasury, because to be quite frank, they don't think about sports clubs very often. And I think when we approached them, it made them think about it. And hopefully that those thoughts will be reflected in the guidance they come up with. But it does demonstrate that final point, that review of your corporation tax position is essential, because you've got to deal with these the taxation of these business support grants. So, having thrown that one in, we can't answer this question really at the moment, but we need to look at it. What about the good news stories about exemption from corporation tax? Well, the first slide I will briefly go through because I don't want to bore you with, I'm sure, subject you're familiar with, but registration with the revenue as a community amateur sports club delivers tax exemptions. It's a good scheme, and effectively you can work in a tax-free zone as far as corporation tax is concerned. Just to recap, interest and capital gains are fully exempt. If you've got trading income, remember that member income, the non-member income from the bar, you can have at least up to 50,000 of that gross income, the gross sales, and it will be exempt from corporation tax. You can have gross rental income of up to 30,000, and that will be exempt. If you exceed either of those limits, then I'm afraid you'll have to compute the taxable profits based on the full amount of the income. So if the trading income was 60,000, then you don't knock 50,000 off and just work on 10. You have to work out what the taxable profits are on 60. An important condition is that you must apply your income and gains for the purpose of rugby, but I don't know many rugby clubs that wouldn't be doing that anyway. So, but that is just a caveat. Now, if you do exceed those two income limits, then it is possible to set up a trading subsidiary to run the bar, for example, and run the hiring activity and avoid corporation tax. That would be a subject on its own, but you will find some very helpful material on the RFU website on that. So similarly, charity, corporation tax exemptions. I know it's becoming, well, rugby clubs look at this when they're looking at their tax benefits, tax breaks they can make. Very similar exemptions for a charity, although there you have to register not just with the revenue, but with the Charity Commission, and that brings with it quite a lot of accountability, reporting, etc., etc. However, if you are registered, interest and capital gains are exempt. Again, as for CAS, property income is exempt without limit. Trading income or income from rugby is exempt, so it's slightly different. Again, no limit. Trading income for other activities, for example, the bar, are not exempt, but maybe if the level of the activities are small. And if not, in the same way as for CAS, you can set up a trading subsidiary to take on that non-exempt trading activities such as the club bar. And again, if you're a charity, but anyway, for tax purposes, you must apply your income and profits for charitable purposes. So two very good and worthwhile registrations to consider in order to protect yourself from corporation tax. So we're on the home straight now. The penultimate poll, Alex.
Yeah, so thank you, Richard. So we're coming to the end. Another poll, it's with you now. Does the club have to submit a corporation tax return if does the club only have to submit a corporation tax return if HMRC request it? Yes, no, unsure. Yeah, let us know your thoughts. As I say, we've come to the end of sort of our quiz sort of approach to this one. I'm going to gather those poll results now. So, yes, 20%, no, 73%, and 7% are unsure. I'm going to publish those results to you.
Oh, that's excellent. I mean, the 73% said no. Hopefully they're saying no for the right reason, but we're on the home straight, as Alex said, on the compliance side. And if any of you in the audience are old enough to go back to the last century and be involved in tax in any way, you'll realize that it used to be the revenue used to chase you for returns and payments and all the rest of it. And I'm afraid lots of accountants used to string them along in a grand old way. But the situation is, as we will all know as individuals, it's self-assessment. So the responsibility is on you as a treasurer, as a club, to look at your corporation tax position, and if you think you've got taxable profits, to self-assess without being asked to do so. Even if you don't think that you've got a liability, the revenue may ask you to send in a return, and it's very important to, if they do that, or even if they don't and you don't self-assess, and you should do, that you may be liable, you will be liable for penalties for failure, and if there's tax to pay, there may be penalties on the tax, interest on the tax, and of course you pay the tax itself. So it's not something that you want to cross swords with the revenue on. You have to register with the revenue. One of the guidance in the resource will give you a little trail there of steps to take. I'm not going to go through those. It's an online filing. Accounts have to go in as does the Ct 600, which is the corporation tax return, and you may submit computations as well. So obviously that's what you need to do with the revenue, and I would advise everyone to submit those returns, if you have to submit them, promptly, because you have a year from the end of your, generally from the end of your accounts end, to submit the return. But if you're in a position to do so and you're happy to do so, submit it early, because that starts the clock running for any Inland Revenue challenge. So if they haven't challenged it within a year of submission and you've fully disclosed all the relevant information to them, that's it. They can't go back, and you're home free. You've probably got it right, but if you haven't, they're not going to pick it up. And obviously, I speak to many clubs. I was speaking to one earlier on in the week, and they were talking about working with a local accountant. I think he was doing it on a voluntary basis to go through all what I've been talking about today and help go through the accounts and help the treasurer, or in this case, I think it was the chairman, help them with the CT returns, which after my conversation, which lasted about an hour, they realised that they should have been filing. So, is that invariably the situation? Well, no, it's not, because fortunately, there is a concession for what I called small clubs on that slide. In fact, the revenue calls them dormant clubs. They treat clubs as dormant for corporation tax purposes. And the main condition for dormancy is that there must be a small actual or expected liability for the particular year of £100 per annum or less. Now that grosses up to taxable profits of about 500, I think, perhaps slightly more. And so you don't get it automatically, or the revenue may actually write to you and say, well, you've been filing returns, we don't think it's worth it because you're small and dormant. But generally, in the cases I've been involved with, we've had to apply to HMRC for dormant treatment. And it's quite a good approach, because if you're uncertain about the treatment of certain items, then you can write to the revenue. There's an office that deals with this. Send your accounts explaining why you don't think you've got a liability of more than 100, and they will respond. They may ask you questions, and they will respond. And if you're eligible, they will grant you dormant status. But you should have that written approval, because if you haven't, then technically you have to file returns, even though the liability may be small. The benefit is that you don't have to file returns for the following 5 years unless something significant changes in the way you operate, and obviously the expectation of the liability increases. And then the revenue say they will review it. So that's very much worth looking at from the point of view. It may save you work, but it may also, that approach may actually let you, well, not sleep at night, but may give you more comfort that what you're doing is right. Because with a self-assessment system, unless you actually file, you don't get that comfort. And then you get the comfort if you filed and it's not challenged, which in general terms, if the revenue object to something you're doing, all they can do is say you must change it in the future, generally. So I think that's about all I wanted to cover, other than to sort of recommend that you take some action now. Well, certainly when you produce your accounts for the latest year, have a look and see whether you have got the potential to have a corporation tax liability or profits. File your corporation tax return where required. And if you come up with a problem for the latest year, consider going back to previous years to see whether the problem still existed, because you will get some brownie points if you show that you've actually sorting matters out and going forward on a firm basis. And take some professional advice. It's not necessarily going to be expensive, but if you do it for 1 year, and you've got a firm basis, that's an investment that's going to be worthwhile for the future. It's been quite a whistle-top tour. I hope I've raised awareness for the management committee and treasurers that are listening in. I realise you're all volunteers, you're not all accountants, but this is probably an area where it's worth looking at some accountants' support from your local guy who will be filing CT returns for other businesses on a regular basis. And I would sort of refer you, as Dave said earlier, to the sort of simple flowchart in the resources. It may act as there's a lot to take in. It may act as a useful checklist when you come to consider this. And well, thank you for listening, and I hope this has been helpful to you.
Alex, you've got a final poll?
Yes, so we just want to class now. This is the last one of the night. But how are you feeling about it all after hearing some of that stuff? Is it How confident are you that you will be able to determine the club's potential corporation ticks? Obviously, with the right support, which is very important in these areas. But are you feeling very confident, or are you not confident at all? Okay. Okay, that should be with you now. I'm going to gather those results in. So, 13% are confident, 67% are confident, and we got 20% that are not so confident there. Just to finish off with, I'm going to hand back to Dave to conclude the webinar this evening. Thank you for joining us.
Thank you, Alex. First of all, my thanks to all of you out there who are listening in and giving up your time. I appreciate this is an interesting topic and can be quite difficult at times, but hopefully that's given whetted the appetite to maybe find out a little bit more. I would just also say two or three things. One, great thanks to Richard for his time this evening. Richard's also a consultant who does a lot of work in the cask and charity field with us. And for giving up his time this evening. I would also just reiterate two other things. Is that one, we have this broadcast is recorded live and will be available on demand, but also will be made available to those that have registered for it. So it may give you an opportunity to go back and have a look at maybe one or two of the areas that you might want to brush up on. And again, as has been mentioned throughout, there is some really good resources in that resources tab that you've got. I would suggest, if nothing else, you look at that flow diagram just to have a look at that. And apart from that, I'll finish by saying have a really good rest of the evening, and let's hope that we're all back on the field doing what we really enjoy as soon as possible. Thank you and good night.